Good everyone, welcome to the Foley's NDI Checkpoint web conference series call. Today's call is being recorded. At this time I would like to turn the conference over to Jessie Lockman-Allen. Please go ahead.
Thank you, Mark. I'd like to welcome everybody to today's first session of our 2013 National Directors Institute web conference series. We are in our 12th annual NDI season, a program that we started in 2002. Through our NDI programs, we are looking forward to sharing the insights and experiences on corporate governance issues that we think matter most to you. The goals and objectives of our NDI program have always been to provide practical insights and useful takeaways to directors, executives, and boardroom advisors. Materials for our previous NDI webinars and other sessions, including PowerPoint presentations and audio recordings, are available on our dedicated NDI website, which is foley.com/NDI. Information regarding future NDI webinar sessions can be found on our NDI website as well. We held our in-person 2012 NDI Executive Exchange in Chicago on November 14th. Please go to our NDI website to find many valuable program materials from that all-day program. Our next invitation-only in-person NDI will be held Wednesday, November 13th, 2013. Be on the lookout soon for save the date and other information. I'd like to take the opportunity now to thank all of our NDI co-sponsors, many of whom have been supportive to us for years and some of whom are new to our program this year. Aon Corporation, D.F. King, Eversheds, KPMG, and Morgan Stanley, as well as our in-kind sponsors, Boardroom Bound, Inforum Board Access. Today, our program is entitled The Current State of Takeover Defenses, What Do Takeover, Preparedness, and Defenses Mean Today? Today's moderator is Pat Quick. Pat is a partner at Foley & Lardner in our Milwaukee office. For over 20 years, Pat has represented a number of public companies on governance and takeover preparedness and takeover defense matters. Speaking today is Tom Miles from Morgan Stanley. Tom is a managing director in Morgan Stanley's investment banking division based in New York and is responsible for the firm's North American Industrials M&A efforts. Also speaking today is Rick Grubow. Rick is the senior vice president of D.F. King & Company and co-director of the corporate proxy division there. D.F. King is a leading full-service proxy solicitation firm specializing in complex corporate transactions. Rick primarily advises corporations and shareholders involved in transactions specializing in corporate control situations such as proxy contests, mergers, and unsolicited tender offers. Before beginning today's discussion, a few housekeeping items. Today's program will last approximately 1 hour. The PowerPoint presentation will be available on our website at foley.com/NDI by early next week, or simply click the Download Files button along the right side of your screen to get a copy of the slides today. If you experience problems with Adobe Connect, please call 888-569-3848 for technology assistance. For audio assistance, dial star then 0 on your telephone to reach an operator. Today's program has been set up in both a discussion and an interactive question and answer format. We encourage you to submit written questions during the program. Type your question in the Q&A box on the right side of the presentation slides. We will respond to written questions at the end of the program, time permitting. If we do not have time for Q&A at the end of the program, we will be sure to follow up with you offline. To ensure you get the most out of today's presentation, we encourage all participants to maximize the PowerPoint to full screen usage. You can do so by clicking the full screen button located above the slides. As a reminder, today's program is being recorded and will be available on Foley's website by early next week. Foley will apply for CLE credit after the web conference. If you did not supply your CLE information upon registration, please send an email to Kemmeter at ekemmeter@foley.com. Please note, those seeking New York and New Jersey CLE credit are required to complete an attorney affirmation form. A 5-digit code will be announced during the presentation. Email the code to ekemmeter@foley.com, ekemmeter@foley.com, to get a copy of the form, or simply click the Download Files button along the right side of your screen to get a copy of the form today. Immediately fill it out and return it after the program. Also note that you must log on to both the audio and video portions to obtain CLE credit. Finally, it can take 6 to 8 weeks for us to obtain all CLE approvals, and we do appreciate your patience. And now, finally, I will turn the microphone over to Pat Quick of Foley & Lardner to begin today's program. Pat?
Thank you very much, Jessie, and thanks very much to all of you for joining us today. We hope this is informative. I wish I had better news for many of you, but it is what it is. Today's topics are listed on this slide that you see in front of you. We'll give a brief update on the current M&A market, talk a little bit about what takeover defense is, what that term means in today's environment, look a little more closely at structural defenses, talk about ongoing efforts to dismantle defenses and how to deal with them, address employee protections in this context, also discuss other means of defending against actions in this environment, steps to follow for advanced preparation, which is more and more important these days, and then address some reminders about ways in which a hostile overture might unfold in the current climate. So we'll begin. Tom will give us his views on the M&A market and the threat of hostile takeover activity today. Tom?
Terrific. Thanks, Pat. What I wanted to do was just spend a couple of minutes talking about the three aspects of the M&A market that are going to be important to the rest of the discussion to maybe set the stage. And so I'll talk about the general level of activity in the M&A market in the U.S., then into the amount of unsolicited and hostile activity in terms of pure hostile takeovers that are going on or are relevant in the marketplace today. And then the third topic, particularly relevant for the audience, is going to be around the significant increase in the activist investor activity that's occurred. And again, as the hostile defense, if you will, evolves, that's an increasing amount of time in the boardroom being spent, one, dealing with it, and then more importantly, proactively trying to address it. So in the first part of that, the global M&A market, 2013 started off with a big bang, and we saw, particularly in the popular press, a lot of reporting about the resurgence of M&A and how that M&A in 2013 in the first quarter was booming. Let me just give you a few figures, and we can put it in context what that means. The overall global M&A volume was up about 10% over 2012 on deal volume, so about almost $500 billion of deals. However, there were 616 deals in the quarter. That's 9% down from 2012. So again, in the first quarter, you had a series of very large deals. Dell comes to mind, Heinz, the Comcast NBC deal was finished, and those are all very large deals, and those really drove that dollar volume number. And so on a global basis, while you've got a 10% up increase, you got a 9% reduction in actual units in activity. In the U.S., because those deals were principally U.S., those big ones, the M&A volume in North America was up 50%. However, the units, the number of deals, were down 4%. And so you think about that context versus 2012, which was by no means a banner year. We're not in what I would consider just yet a bullish M&A market. To put that in a little more context, that global M&A volume of nearly $500 billion is about 24% down from 2011, with the unit volume 22% down from 2011. In North America, those numbers, even though they're 50% up versus last year, as I said, that's 8% down versus 2011. And those units, the 262 deals that have occurred in the first quarter in North America, are 21% off of the 2011 pace. So I would characterize the M&A market as stable to last year. While there are a few bigger, few bigger deals, which always is a good sign, it's the units are slightly off of last year's pace. And so, the M&A bankers who are out there like myself have been saying for a year now that the market is just about on the precipice of turning, and that we're going to see a lot more regular way M&A deals, both solicited and unsolicited. And the driver behind the thinking is the environment on paper is just about perfect for M&A. You've got low cost of financing. You've got a very, very low, historic low cost of financing. And the topic of cost of capital is very prevalent in today's boardrooms because it's lower than it used to be. And that changes the way you think about M&A. Lots of cash on corporate balance sheets, lack of opportunity for pure organic growth in many companies, whether that's U.S., domestic, or international. It's harder to find than it used to be. And you've got, you've pushed the limit, the corporates have pushed the limits in many respects of cost cutting, so they've got to find ways to drive the top line and reposition their business. Investors are largely supportive of M&A. Investor reaction to large-scale M&A has been very positive in 2012 as investors really want the companies to put that capital to work in activities that are sort of in advance of their cost of capital. So that's something that is not always the case in cycles, but right now investors are rewarding M&A. And then finally, you have strong equity markets. And again, the multiples are lower than they were in the past peaks of 07 and 2000, 1999, 2000, but you do have very strong equity markets. And those conditions all usually set up for strong M&A. And clearly the reason for the lack of activity is a little bit boardroom and CEO confidence. We have gone, you have 2008 in the rearview mirror pretty recently, and we've been jumping from, as everyone knows, from headline crisis to headline crisis, whether that's the U.S. debt downgrade in 2011, the European meltdown in 2012, the elections, the fiscal cliff, the sequester. All of that causes enough consternation in boardrooms that their people aren't as aggressive as they might have been. And so that transitions into, you say hostile activity. I think sellers, by and large, the last period of real hostile activity that we had, if you look in the U.S., there was a good amount of hostile activity in 2008, maybe surprisingly. But that was driven by the fact that buyers and sellers had very different points of view on value. And therefore, the buyers were more aggressive relative to trying to let the shareholders determine, what the right selling price was for the company. So you saw a number of big valuation gaps. At least in my mind, that doesn't exist as much today. And the reason that the activity is lower is not on the sell side; it's more on the buy side. You've got that lack of confidence I talked about. So the hostile takeover market at the moment is a consistent part of the M&A market, but it's a small part of the M&A market. Has been for the last several years, and it's you see a handful of deals every year that are important and are high profile, and in many respects, a lot of what we'll talk about today in terms of the structural defenses and how you prepare for them. But there's not a flood of hostile activity that's hit the market, or really that's expected to hit the market in the very, very near term. However, that does lead to that next piece of the market, which is the activist activity. The conditions I mentioned before of low growth for corporates are also low return in this interest rate environment. In this investing environment, it's a reasonably low return environment, causing investors to need to create what they'll refer to as alpha, create return on their own, systematic, asymmetric upside in individual stocks. And so they're looking for opportunities to do that at companies and to create the event in order to drive the stock price. And they've had, as everyone has read in the papers, this is a growing business for an asset class, if you will, amongst hedge funds. And there are a number of activists who've been very, very successful, both from a return perspective and at affecting change at smaller corporations, but also increasingly larger and larger corporations. And that growth in activist investing is focused, oftentimes on capital structure. So, this cash balance increase that I talked about, in the immediate aftermath of 2008 and 2009, people were not criticized for having so much cash. As we get further and further away, using that cash, trying to drive return, whether that's through buybacks, dividends, or M&A, is something that activist investors are pushing. I'm sure we'll come back to it later in the program here as to sort of how to prepare for that. But from a increase perspective, what we have seen an enormous increase in is shareholders, both activist investors and, frankly, traditional long-only investors, being more vocal about how they want the corporations to sort of deploy capital. Capital allocation is a big theme, whether that comes in the form of business portfolio allocation, i.e. how many businesses you have, or capital structure allocation in terms of what you do with the excess capital. And activist investors are becoming more and more focused on that. And then on the last piece of that is governance. They're using, in many respects, they're using governance as a lever to pull inside of corporations and trying to get on boards using tenure of board members. And we'll talk about some of this later in the program. But they have certain levers that they traditionally like to pull. And, when we think about the threat of hostile activity, it's no longer just, company A is going to buy company B because there's lots of synergies and they can pay a big premium, and company B doesn't want to sell. It is more and more about the activist investor trying to force something on the company. And in many respects, the companies oftentimes would have done that on their own timetable, would have done the particular strategy on their own timetable. But what they're increasingly being forced to do is react to timetables that are set for them by investors and proxy fights and some of the other things that come along with that. That I'm sure Rick will talk about when he goes into his section. But I just wanted, that's the backdrop of where I think the market is today for both regular M&A, hostile activity, and also activist activity. I don't have a good measure on how much activism has increased, but I tend to use the practical method of how much time does it take within our M&A group and within our coverage groups to really assist board of directors and management teams on, one, preparing for, and two, dealing with activist investors. And that amount of time has just skyrocketed over the last 2 years, and it's been palpable increase in that that boards are spending more and more time focused on these issues. In some respect, that's good because they're focused on the sort of issues of corporate governance, and in some respects, they're spending less and less time actually running the business. And so there's a trade-off there that I think is reaching, in certain companies, is reaching a high point. So I'll pause there, and Pat, turn it back over to you if that works.
Thanks, Tom. That's very helpful. Rick, anything to add to that?
Yeah, I'll just put some stats to what Tom was mentioning regarding sort of the recent increase in proxy fight and activism activity. In 2008 we hit the peak of defined proxy contests, where there was an actual dissident mailing material and going all the way to a vote, where there was 126 proxy contests. Dropped all the way to a low of 68 in 12. A lot of this is due to obviously the hedge fund community getting their house in order, the lack of M&A activities. A lot of the not too much of a secret of it, but a lot of the activists really are just trying to drive companies into the hands of a suitor, whether that's private equity or a competitor. And since that dried up, the activists are not willing to spend so much of their own money waging a campaign if they don't see a light at the end of the tunnel there, or a quick way out. But to put some context on what we've seen so far in 2013, is we've seen a 25% increase in the first 3 months versus last year in overall contests. We've seen an 80% increase in contests of companies $1 billion and more, from 5 in 2012 to 9 in 2013, and an overall increase of 11% in the others. And so what that does is sort of put some context on the activists are gaining ability to go for larger and larger prey, where we've seen companies as big as Procter & Gamble even threatened by activism. A little context of I'll just throw out there the proxy advisory firms. Obviously, we all know the proxy advisory firms sometimes are very pro-shareholder oriented. ISS has supported dissidents just over 60% of the time when they are going for some type of minority representation. And that does not include the number of contests that were settled because the companies were well aware that the chance of success was bleak at best. So although the activist success rate has actually dropped off from 59 to 51%, much of that also can just be traced to companies being able to have a better handle of what their chance of success and reaching out for settlements in the face of certain defeat. And Pat, back to you on that.
Okay, thank you for the great news. We're now turning to the next topic, which is, in a way, a philosophical and big picture topic. What is the takeover defense today? So in today's world, staying at the status quo is rarely an option. Companies are constantly reinventing themselves. There are, in response to various pressures, competitive and otherwise, and there are other dynamics in the market today, including the speed of market activity, the growing power of shareholders, including activist investors, and you've heard that already, and you will hear more about it, and of course the speed with which information moves these days. So when you think of a takeover defense, what is a company defending against? That is, what is the threat that you seek to have a defense against? And it's, of course, the easy case, a hostile takeover attempt or a threat to independence, but there's also the threat to a strategic plan, actions, including those of activist shareholders that undermine the ability of board and management to determine their own destiny. As Tom noted, a company might have along the way reached a decision to divest a segment, but more and more activists and others are trying to change that timetable, and so a defense is ideally a way to avoid having someone else determine the timing and the agenda. And of course, also defending against the idea of an outsider elected on the board through an election contest or a threatened election contest. And with that bigger picture view, we're left looking at what is a defense these days. And of course, the easy thing that comes to mind, and we will talk about all of these in more detail, but the first is a structural defense. But we're seeing more and more the idea that there are other things that not only make business sense, but are in essence defenses against these types of threats, and they include business strategies, capital strategies, and just shareholder relations has become a takeover defense in the current climate. So now we'll talk in a little more detail about structural takeover defenses. The purpose of these is, at a minimum, to give a board and management more time and the means to defend against the threats that they perceive, the undesirable actions, if you will. And my apology and also my lament in this context is twofold. One, there's really nothing new in terms of structural defenses. And secondly, there's no silver bullet here. So if you tuned in looking for good news on this front, I am sorry to disappoint you. What remains in the context of pure structural defenses end up more as speed bumps than showstoppers, and again, there's not much new. Due to the fact that the traditional structural defenses require shareholder approval to implement, there is little these days, and this has been true for some time, that an existing public company can do to add to its structural takeover defense arsenal. At a minimum, a company must have annual meeting advance notice bylaws, and if you have them, you should make sure that they address derivatives, that is how shareholders hold securities and interest in your securities through derivative instruments. So this is a must-have, and it's a relatively easy element of an arsenal. I am hopeful that most companies have advance notice bylaws, but if you don't, now is the time. Kind of hand in hand with those are bylaws that set up procedures for special meetings of shareholders, assuming that shareholders have the ability to call special meetings one way or another at your company, and consent solicitation procedures, again, assuming that at your company shareholders can act by written consent. If those circumstances exist at your company, you should have bylaws in place that set forth procedures that bring a little order to these processes. These are important elements of an arsenal, and Rick can speak to the extent to which these are an accepted part of an arsenal.
Yeah, I'll just add to that this is probably the only area that ISS and the majority of the institutional investors can see eye to eye with the issuers on the need for some level of, as Pat said, it's a speed bump, that's all it is. And ISS and the institutional investors do not give any pushback to having a reasonable set of advance notice procedures. Typically, it's 60, 90 days prior to the meeting date for the notification of nominees. And they're also okay with procedures tied around consent solicitations. And institutional investors kind of got the understood the issue once they realized that you can do a consent solicitation and not include all shareholders. So and the institutional investors do not ever want to be bypassed in a consent solicitation procedure, so they do not give any pushback on that either. So when it comes to defenses, I wouldn't put it as a major defense, but it is the only thing that you can put in your defense arsenal that will not get the wrath of ISS and the proxy advisory firms.
Thanks, Rick. Also on the list, of course, is a poison pill rights plan, and this still remains something that can be a part of an arsenal. We'll talk about that in a little more detail. One can also pursue amendments to applicable corporate law, and we'll spend a few more moments on that topic as well. We have on the list seeking authority for additional common stock. We're grasping a bit in terms of these last three items, in part because there's not much else, again, on the wish list for companies that need shareholder approval, seeking authority for additional common stock. Who knows how that might come into play in responding to various threats, but it is helpful to have as much room as possible up front. Establishing an ESOP, that has not been fashionable of late, but it's something that you should keep on the list and consider under appropriate circumstances. And also examining employee plan terms to make sure that they say the right thing on voting and tender decisions. In terms of clean slate takeover defense opportunities, there is the long list that includes staggered board and in the extreme a dual class structure. Those are available, surprisingly, in a way, for companies embarking on an IPO or companies about to be spun off. So they are generally available at the time of the transaction, but fairly quickly those companies will draw the usual reactions from institutional and other shareholders. Back to a poison pill rights plan. Maintaining a plan is far less common these days, but a rights plan is still a worthy tool to have on the shelf, if nothing else, keeping it in mind and being ready to implement it at an appropriate time to contribute to a defense. Of course, types of rights plans, there's a traditional original 10-year plan, an NOL plan coming out of the down economy. Companies put in plans to make sure that there were not share accumulations that would have the effect of adversely affecting a company's NOLs, and those gained some acceptance among shareholders and the advisory firms. A shareholder-approved plan is something that that a company can maintain. Rick can talk in a moment about what it takes to get there. And in the right situation, that is in the face of an actual takeover threat, companies can adopt a rights plan, and you get a pass of a bit of a pass from shareholders and the advisory firms under the right circumstances. The bottom line is that shareholders and advisory firms do object to rights plans. The traditional plan is the most objectionable. Under certain circumstances, as I said, you can get a pass for other plans. The term of the plan is important, particularly when you cross 12 months, you're in trouble. And with that, I'll turn it over to Rick.
Right. I think most companies today, given ISS's procedures on withholding on directors for any non-approved plan, go with the route of having a pill on the shelf, which will be ready in the right circumstances, or the wrong circumstances, I guess. But sometimes companies do want to go to the shareholders and get their pill approved. Sometimes if there's a large shareholder that's creeping up, that the only way to sort of stop that is to get a shareholder-approved plan in place. And so ISS has a number of procedures which require a qualified offer clause, which allows sort of like the advance notice. This is a speed bump. Although it has some time, they need to require an issuer that there's a qualified offer clause that allows for a shareholder to ultimately call a special meeting when there is a qualified offer on the table. And so ultimately it will give a bidder 6 months or so before there could be a special meeting to address the issue. And ISS will approve a plan if it has the right procedures in place. Most companies are not taking that approach and prefer just to go with a pill on the shelf when necessary.
But it is worthwhile, very worthwhile, to keep the subject in front of the board by keeping a fresh plan on the shelf, including a plan that addresses ownership through derivatives, so the board is ready to act and understands the terms, understands the process and the effect of the rights plan. So this is something, and we'll talk more about it in the context of preparedness, that a company should keep in front of the board. We'll talk briefly about pursuing amendments to corporate law. This is a bit of a reach, and there is danger involved in terms of shareholder relations. Running to the legislature was all the rage in the 80s, 70s and 80s. It has crept back in the last few years, particularly with the elimination of staggered boards. There have been a few statutes that have required a staggered board for companies incorporated under the applicable statute. Of course, there's the option of getting a control share statute or restrictions on business combinations, or tuning up existing statutes to pick up things like derivative instruments, and of course constituency provisions. A company must tread very carefully here, however, because open support for this type of legislation can trigger the ire of investors and proxy advisors. And I think the ultimate punishment would be a push for reincorporation in a more shareholder-friendly jurisdiction. Examples you can see in Indiana, Iowa, and Oklahoma of statutes such as a mandatory staggered board. We're now going to talk about dismantling of defenses, and unfortunately over the last 5 or 6 or 7 years we have been going very much the wrong way in terms of takeover defenses, as shareholder proposals have targeted dismantling defenses in terms of staggered board, supermajority vote requirements, seeking ability to call special meetings, and seeking ability to act by consent, eliminating blank check preferred stock, and requiring shareholder approval for bylaw amendments, all with, unfortunately, a fair amount of success, although in some cases more than others. When you get a shareholder proposal like this, the first thing to do is step back, understand the landscape, don't rush to act. Understand where the proxy advisory firms are likely to come out on the issue, given your particular facts and circumstances, and consider your ability to win on the issue despite an adverse recommendation from the advisory firms. I don't know that, at least on some issues, I have the hope that there remains a possibility that you'll be able to win a vote despite an adverse recommendation. And Rick, do you want to address that?
Certainly. The main proposals to de-stagger and allow for a special meeting or written consent get an overwhelming majority of support from the institutional shareholder base. Just on the staggered board issue, there's a handful of companies that are able to defeat it each year in the S&P 500, and most of them are able to defeat it only because of their unique share ownership structure of founding shares and large insider positions. Just to put some context on the state of where we are with the staggered boards, right now in the S&P 500, 84% of the companies have de-staggered their board. Okay, and we have seen a wave of shareholder proposals by the Harvard Shareholder Rights Project, which is Lucian Bebchuk. And by the end of this calendar year, so many of the companies that have not de-staggered as part of the S&P 500 will have received the shareholder proposal, and many of which will have lost the shareholder proposal. So by next year, many of these companies will be forced to capitulate and opt to de-stagger their board. So virtually the S&P 500 by the end of next year will have eliminated their staggered boards. It's still, right now it's 56% are declassified at the Russell 3000. One other issue I'll just throw out there is the difference between written consent and special meeting. The institutional investors have sort of taken a new look at this as recently as last year, and they believe that there needs to be a path outside of the annual meeting process, but they're not so hung up anymore on whether it is a special meeting or a written consent. So we've actually seen the results of these shareholder proposals go down significantly if an issuer has a path for a bidder to move a bid forward outside of the annual meeting process. But that said, it's not good news for most. All right.
So in this context, the idea is to seek to delay as long as possible. I guess, Rick, if you get one of these proposals and it's a loser, is there any downside to taking it to a vote to try to extend the process?
Not really. If you get a de-stagger proposal and you're going to lose, there is no real harm, no foul to take it to a vote, lose the vote, and then the following year, and I'd like to point out that ISS has recently changed their policy on that it is now if you lose a proposal only 1 year, they expect the issuer to substantially incorporate that into their next year's annual meeting. But it will give you more time, and then it is accepted to phase in a de-stagger proposal. So it does buy you a couple of years of additional protection by just allowing it to go to a vote.
Next, we'll talk a bit about employee protections in this context, and this is more by way of housekeeping rather than takeover defense. Very important housekeeping to keep employees happy and in their chairs and have the proper incentives, but it is not really a takeover defense. And of course on the menu here is our golden parachutes, tin parachutes, which are more broad protections, equity and incentive plan, change of control protection. There has been more and more of a push toward double trigger protections rather than single trigger vesting or payout on a change of control that is also requiring a termination of employment. But that in terms of the compensation plans has not been as strong a demand on the part of shareholders and the advisory firms as it is in the context of the golden parachutes, the agreements for senior executives. There's also the concept of protecting overfunded pension plans. I'm not sure how many plans out there are overfunded these days, but this should be on the list if your circumstances are unique in that regard. Of course, in terms of golden parachutes, there remain shareholders who are very interested in the terms of those. The benefits have to be no more than 3 times annual pay, and more and more the trend is headed toward 2 times. As I noted, they should be double trigger, and there should be no gross-ups. As the slide notes, the ultimate limitations here are the fact that proxy advisors are watching, paying very close attention to these terms, as are shareholders. At this point, I'm going to announce the code for CLE credit, 5-letter code SJONP. That's Sam, John, Oscar, Neil, Pat. Thanks. Sorry for that interruption. We're now going to talk about other means of defending in this context. And this goes back to where we all started with Tom talking about how business strategy fits in. So we're going beyond pure structural defenses, and what does it take to these days to defend against a hostile acquirer or the activist who is seeking to cause an event for purposes of generating a return. First of all, good performance is the best takeover defense. Good consistent performance that evidences that sticking with management and sticking with the plan that management has presented is a better option than the alternatives that outsiders are proposing and advocating. And all these points go hand in hand, but together with good performance is having a plan going forward, both a sound strategic plan and a realistic business plan that tracks a strategic plan. Realistic in the sense that shareholders will believe the path that management is headed down, that believes that it will generate superior returns. So you have to be able to sell that to shareholders. And this plan includes a full examination of business strategies, capital strategies, and understanding the key areas of vulnerability in the plan and coming up with ways to address those, anticipating those such that you're ready to defend the plan against attacks. Tom, do you want to add to this, please?
Sure, and I think the key here really is the consistency of the review at the board level, because in our minds, what we see a lot is more and more companies looking to keep a very fresh, realistic business plan that the board believes in, the board is familiar with, so that you're not caught in a situation, whether it's an acquirer trying to put a value on the company, or an activist trying to get you to do some sort of corporate event. Ideally you've already reviewed that option because you've been thinking about it and have an answer. Whether that's good, bad, or indifferent will depend on the situation. But more and more what we're doing with companies is getting in at the board level and doing an external third-party review of the different options that they could consider, not for them necessarily to do any of those things in the near term, but so that they know what that looks like. And increasingly the long-range plan that in years past might not have been frequently refreshed is a key element of that, because as you think about how much cash flow a company is going to generate over a defined period, you need to be thinking 1 year, 2 years ahead in terms of what your capital structure needs and capital needs are, so that you can develop that plan ahead of when someone may be coming. And I'm thinking specifically about an activist there, in terms of what to do with the capital. So I would just echo that, and I know we're going to get into advanced preparation, but there are a lot of companies who still either get a hostile or unsolicited proposal that values the company specifically, and they haven't had and they have to take 2 to 3 weeks to get an advisor up to speed, get them refresh their plan, and sort of see what the answer is. Companies who have already done that and who already have the thinking well underway are just materially better at addressing and dealing with either a hostile or unsolicited acquirer or an activist investor, because they're much more able to act on their front foot.
Thanks. And the third main bullet here is shareholder relations, and we'll talk more about that as well in the context of advanced preparation. But that has become more and more important in these days, and knowing your shareholders, knowing what they're interested in, and again, we'll get into more detail, but that has become far more important over the past few years as companies find themselves negotiating, in essence, directly with shareholders and comparing the management view of the world with that of an activist shareholder who's suggesting something different. Of course, in the context of shareholder relations, you have to be very mindful of Regulation FD, the idea, of course, that you can't share material public information with individual shareholders in meetings that you haven't shared with the world. A corollary of that concern is that companies have been, in my view, more open about their strategic plan and their decision-making, what they've considered and the like, than they had in the past, so that they can more freely talk with shareholders about it. And that is then drives kind of disclosure, a company's disclosure and how it addresses a strategic plan. Perhaps it has an annual analyst meeting where it dives in more detail into its businesses, but as part of that, a company should be mindful of what it wants to talk about with shareholders in one-on-one settings down the road, and drive overall public disclosure in light of the shareholder relations activities that they'll have in the future. Which brings us to advanced preparation, and there is a long list on the following two slides, and we'll talk about some of them in greater depth. But advanced preparation is more and more critical these days, and it's beyond just having a the defenses in place. It is kind of a way of thinking and a way of conducting yourself, recognizing that as a public company, you are vulnerable to threats from outsiders. So this has to be a way of life rather than something that you deal with when you get a phone call. So first on the list is knowing your shareholders. And Rick, could you expand on this a bit, please?
Certainly. Yeah, right now, shareholder engagement has never been as important and never more challenging. The investor bandwidth is so limited now with the onslaught of say on pay. The investors just don't have that much time. However, we routinely see time and time again where companies find themselves under attack by an activist, that they really don't have great relations with their top shareholders, and much is because their shareholders have grown frustrated over the last few years, and so when they're frustrated, they don't feel they have much to say, so they just kind of shut down communications, and that just is never going to work, and that just feeds into the activists, because many times if the issuer is not talking to the large shareholders, the activists are talking directly to them. Also, you have to understand who your shareholders are and how they operate, because they all kind of act a little differently. And one thing about shareholders is they've all got a different opinion on how you should run your company, how you should compensate your key talent. But you've got to be out there meeting with them, talking to them, as well as many companies solely focus on their long-only mutual fund type institutions, and they ignore all of the index funds, which the index funds don't really want to engage with you other than discussing corporate governance-related topics. And many times, all they want to do with those engagements is push issuers into a better corporate governance structure, and many times companies are reluctant to embrace those types of engagements because they don't really want to change. However, in order to maintain the good relationships with these investors, you have to speak to them regularly. You have to know when to speak to them. They don't necessarily want to talk to you right in the height of proxy season when they've got everybody else looking looking for their time. But it is most investors will at times embrace some level of engagement, whether that's direct meetings or just phone calls. But I can't say enough on if you can't call the top 10 holders in your shareholder base and have a dialogue, your chance of winning a proxy contest is slim.
And I would just add, this is Tom, I would add the other change that's occurred over the last several years is, and it may be surprising, but this used to be a task that the investor relations team sort of handled, and they would bring in the CEO, CFO more occasionally. This is not, this is CEO, CFO type engagement that we're talking about. And, you know, in boardrooms all over the place, you know, the board members are now asking much more frequently, you know, what is the specific CEO level dialogue that they're having with those top shareholders. This can't be relegated, as it may have been years ago. This is stuff that the top investors really want to have a dialogue with the people that are making the decisions that are in the boardroom, and not just, you know, with the investor relations team. There's a time for that and a place for that, but they are looking for the more senior level dialogue.
Indeed, they're under the right circumstances, they will expect to see an outside chair or lead director as well.
That's right. We see that on Say on Pay quite often because many times the institutional investors, you know, they want, if they have arguments with the compensation issues, they want direct access to compensation committee members.
And part of this is having an appropriate stock watch service, and these days those services get pretty sophisticated and can get fairly accurate information. It does cost a bit of money, but it does pay to be able to track your shareholders and then understand when a hedge fund or someone who's an activist comes into the picture, understand what they do, what their hot buttons are, and keep that in mind as you go forward. Know your enemy, in essence. The more information you have about them, the better. Next on the list is having an informed board committed to a strategic plan. As Tom mentioned, this is very important. Again, the idea is that if someone comes from the outside and says, you need to consider, you should be doing X or Y, it is fantastic to be able to say, hey, we already considered X and Y, and we like our path better, and here are the reasons why. Where a board is already firmly committed to an alternative path and can forcefully say, we already talked about that. Hand in hand with this is having regular board updates on the subject with advisors, giving the board the landscape on the subject and things to consider. More and more companies are reaching out to ISS to help them understand a company's business and to listen to what's important to ISS. Glass Lewis can be a little harder to connect with, and there's some pain involved in dealing with the advisors, but there is something to be gained from doing that on an annual basis. Of course, you should engage, prepare, and communicate with advisors in advance, including, of course, investment bankers and lawyers, but also a proxy solicitor and an IR or public relations firm. And the sooner you get these people involved and help them get to know you and you know them, you're better off for the long haul. Keep your eyes and ears open about what people in the investment community are saying about you in various ways, because that type of thing it can easily explode into an activist shareholder's agenda or something that someone else tries to exploit. They are hints at what might be coming down the road, and it gives you advance warning on what they might be raising as a challenge to your plan. More in terms of housekeeping, remind your directors and officers not to comment on rumors and to refer any approaches to the CEO. a company should have an up-to-date legal review of the matters indicated in the slides so that you're not rushing to do this when some external event happens. Keep flexibility by avoid committing in advance publicly to future dates for earnings calls and your annual meeting because you might want to shift along the way in light of changing circumstances. It is helpful to anticipate the possibility of reacting to external events by making sure you have procedures and systems in place, kind of like a fire drill. If this happens, who will do what? Who will lead what charge if things hit the fan? What roles will finance, investor relations? You might have a business development person who leads the charge on crunching numbers on various alternatives that are thrown in front of you. Also, ongoing communications with your credit agencies can only help you in the long run. We also, as a topic, have reminders on ways in which a hostile overture might unfold, and there are more shades of gray in this context, but overtures can come in gently or by means of a hammer, and the way in which they come in might raise variables in terms of whether you should respond, how quickly you need to respond, whether you need to negotiate. Generally speaking, there is not a legal obligation to negotiate. Questions about the need to disclose publicly, and also the applicability of legal requirements, including tender offer rules, will depend on the various and state law rules governing notice requirements and the like, as well as your bylaw provisions might vary depending on the ways in which the overtures come in. That concludes the topics that we were going to address. We've kind of run out of time for questions and answers, but I'm going to turn it over to Jesse to close us out. Thank you again very, very much for joining us today. Jesse?
Yes, can you hear me?
And now we can. Thank you.
Oh, sorry about that, everybody. Technology. Sorry. Thank you to all of our participants today, Pat, Tom, and Rick, for your excellent insights regarding the current state of takeover defenses. The contact information for all of our panelists is on the slide deck, so if you'd like to contact one or more of our panelists, please do so. The PowerPoint and recording will be available on our NDI website within 24 to 48 hours. Please mark your calendar for the upcoming sessions in the 2013 NDI Checkpoint Web Conference Series, May 15th, August 21st, and December 4th. Please don't forget that those seeking New York and New Jersey CLE credit are required to complete the Attorney Affirmation Form. Email the 5-digit code that was announced earlier in the program to ekemmeter@foley.com to get a copy of the form, or simply click the Download Files button along the right side of your screen to get a copy of the form today. Immediately fill it out and return it after the program. We certainly hope that you enjoyed today's presentation and ask that you please take 30 seconds to participate in our brief online survey at the conclusion of this call. These surveys are very helpful to us in ensuring that our NDI programs are providing you with practical advice and recommendations and to help us develop ideas for future NDI topics. Thank you again for attending today's webinar, and we'll talk to you next on May 15, 2013. Program details will be announced later this month. Thanks again.
That does conclude today's conference. Thank you for your participation.